How are you? I am Roberto Dargerandi, a professor of the Accounting for Decision Making and Control course at Blackwell Global University, and I welcome you to the sixth session we have ahead, where we will continue from the previous session regarding financial analysis in order to maintain the established order of this course. From the beginning, accounting, and in particular financial accounting, and now here with this important topic of financial analysis. So, having said that, I am going to share my screen to continue with what we are developing. And after discussing these tools of vertical and horizontal analysis, we move on to review what financial ratio analysis is. Now, before we begin analyzing these financial ratios, it is very important to point out that ratios are not financial analysis. Many people think that financial analysis is equivalent to calculating ratios. This is not the case. In fact, it is often the case that many times the ratios are already calculated. Sometimes there is a reasoned analysis of the accounts, etc., and that is where the calculated or estimated ratios come in. So, it's not about facing it that way. Rather, of course, you calculate them, estimate those ratios, but then you have to interpret them. In this sense, financial ratios. As mentioned here, these are probably the most commonly used tools in the financial field, but they are just one of the possible tools among a set of alternatives that are available. Typically, these ratios are calculated as the quotient between two or more accounts from the balance sheet, the income statement, the cash flow statement, or combinations of accounts from these three financial statements. It is also important to teach that each ratio gives us or will give us partial information. If we want to have a complete analysis, it is essential to consider several financial ratios as a whole. One or two of them will never provide us with the analysis we want to achieve. And that's where some elements start to appear that make the analysis less obvious and more complex, beyond just calculating ratios, and of course, discussing it well. One of them is, well, what is our benchmark? Who are we comparing ourselves to? What is our reference standard? Are we comparing ourselves to the ideal company? Should we compare ourselves with the three largest competitors? With an industry benchmark, do I know that it exists? With historical indicators? With an industry average? With a company that has a certain defined strategy? And in this sense, obviously, comparisons of relevant indicators should always be made with companies in the same industry, and we must be cautious when choosing the industry. Many times in this regard, it is not easy to define the industry because, in essence, we sometimes have diversified companies, and at other times we have companies with different lines of business. This happens often, for example, with very large companies that are like conglomerates and have different business areas, even under the same legal entity or also within an economic group. There are times when, for example, in the stock market, there are companies that have different units. And sometimes there is a common business, for example, the forestry business, but other times the other businesses are not common. So there, the comparison is complex. This happens a lot, for example, in the retail world. One suddenly compares two companies that are in retail, but one of them, for instance, is much more focused on retail for individuals selling products like clothing, electronics, and so on. But the other one might be much more focused on the supermarket industry, while another one that is also in retail is more concentrated on the financial business. So, be cautious with these comparisons. Also, of course, there are industries where there are very few companies, or they are dominated by one large company, or there is a monopoly. This happens a lot in Latin America. There is a lack of information. we sometimes do not have much information about the industry or competitors. There are also times when we have a new company, a startup within a new industry. For example, nowadays, artificial intelligence is very trendy. Well, perhaps we don't have as many benchmarks within that industry or that segment of the technology world now. On the other hand, another question that always arises is, how do we choose the most relevant financial ratios? In general, it is most advisable to focus on a few important financial ratios. Few, but important, and more than trying to have 87 financial indicators that sometimes might not tell us anything. In this regard, the results obtained from the ratio analysis should raise questions that the analyst must answer, for example, through a deeper analysis. Now, in general, on the other hand, the analysis of financial ratios tends to be segmented or divided into different areas. For example, the area of liquidity and the topic of work, everything related to activity, indicators of the company's activity, the area of debt and financing structure, everything related to profitability and solvency, and finally, when it comes to companies that trade their stock on the market reasons. We will comment on them. Starting first with liquidity ratios, this is a very important ratio because it allows us to try to understand whether the company can eventually meet its short-term commitments. In this sense, an important associated concept arises, working capital, which is nothing more than the difference between current assets and current liabilities. Now, moving on to specific ratios, at the level of liquidity ratios, we always end up, of course, with the current or circulating ratio, which measures how many times I am able to meet my short-term liabilities with my short-term assets. And here avoid magic numbers. It varies with the industry and company context. Typically, a ratio between 1.5 and 2 times suggests a good level of liquidity. On the other hand, there is a more stringent test, called the acid test ratio, which excludes inventory. Leave out the inventory and penalize it in order to calculate only what is considered current assets. Excluding inventory means that it calculates cash, accounts receivable, and financial investments, but completely penalizes inventory. And this is reflected in current liabilities, okay. And here it is obviously much more demanding. So when one has reasons that are close to 1, a little above 1, of course they are interesting. Now, it is also good to consider that there are really businesses, for example, that do not have much inventory. A service company, such as a consulting firm, does not have much inventory. Therefore, it is likely that the current ratio will be very similar to the quick ratio. On the other hand, there are activity indicators associated, for example, with accounts receivable, accounts payable, and inventory. Regarding the turnover of accounts receivable, I have 2 main alternatives. One way is to calculate the turnover, which is basically the annual sales level divided by the accounts receivable at an average point in time. But it could also calculate something different, which is the average copper period. In rotation, for example, one calculates that in a company the rotation is 12 times. This means that the fund rotates every 30 days. So, one can use the number of times it rotates in a year, or I can use average days. Generally, since people tend to think more in terms of days, the second option is used more often. On another note, something similar applies to inventories. I can calculate the inventory turnover, which is calculated as the annual cost of sales divided by the average value of inventories. Or you could also calculate an average inventory period, which is 365 days divided by the turnover. It also tells me, well, how effective I am in managing my inventory. When one sees that a company, for example, is extending its inventory days, it means that it is probably becoming more difficult to sell, especially if this is accumulating more stock, unless it is a deliberate policy. So it is also an indicator that is very important to understand, especially in those companies that have relevant inventory. The same example as before, so if it is a communication services company, it probably doesn't have much inventory, and this indicator loses meaning, loses value. And finally, among these activity indicators is the accounts payable turnover, where we typically take the annual purchases we make on accounts payable at an average point in time. And conversely, we could place an average payment period of 365 days over the turnover. Now here we need to be mindful of the following. All the items we have been discussing from the liquidity indicator until now have been directly in the income statement or the balance sheet. Purchases have not. Purchases are calculated by difference. As this is stated, one can say that. To know where this comes from, a company's ending inventory is the beginning inventory plus purchases minus the cost of goods sold. If one rearranges that expression, one can come to understand that annual purchases are the final inventory minus the initial inventory plus the cost of sales of those goods. Therefore, this indicator is also very important. It is now important to understand that with accounts receivable days, inventory days, and accounts payable days, we can calculate what is called the cash flow cycle, which basically relates to how the company's operations are reflected. So, for example, if it were an agricultural company, it might have a long period for that agricultural good to be available. And in that long period, we can have, for example, inventory days, including, of course, production, 180 days. I take time after selling. It takes me 30 days to collect, totaling 210 days. Assume the payment days are 60 days. So, 180 days of inventory plus 30 days of collection equals 210 days. 60 days of payment, right? That would imply that the IFRS is how many 150 days. What does that mean? I would need to finance working capital for 150 days. This is called the cash flow cycle. We will see it later in the financial part, cash flow cycle. And it allows us, for example, to understand what the working capital requirements of a company are. A company like that, if it is the case, therefore needs working capital, right? Because there is a lot of timing involved between production, inventory, sales, and what is collected versus how long it takes to pay, right? It often happens with companies, those that sell to large supermarkets, where the supermarket collects payments quickly but pays slowly, and that company selling to the supermarket faces the opposite. You are going to collect slowly and pay quickly, okay. So, these indicators are important for that purpose. We could also circulate other indicators, for example, the total turnover, how much the assets rotate over a period of time. So there we have all the annual sales or the total assets as another indicator of activity or efficiency. So these reasons are important, and we will continue discussing them in the section called Financial Management. Next come debt indicators. For example, leverage, the famous debt leverage ratio, with total liabilities over total assets, total liabilities over total equity. Okay, so here we measure a relationship. What percentage of a company's total assets is financed with debt? Right. Or the debt-to-equity ratio, which is what one looks at to determine how many times the liabilities are compared to the company's equity. Already now, just as we have talked about our indicators, what constitutes a good number or not a good number? It will depend a lot on the type of business and the industry we are in. There are business industries, for example, financial businesses, financial companies that operate as if they were leveraged, meaning they are in debt. They borrow from a certain financial agent to lend. So there, one can find, for example, debt to equity ratios of 4 times, 5 times, 6 times. If I am a construction company, I am probably technically bankrupt with 4, 5, or 6 times. So, this always needs to be viewed in relation to the industry that we are evaluating or analyzing. There are also other debt ratios that relate to coverage ratios. For example, how with the company's results or cash flows we are able to pay interest or make the payment. So there we could take the indicator of earnings before interest and taxes as a measure to understand the company's ability to pay. And again, this needs to be viewed in context. Next come profitability indicators like the gross margin, sales cost of sales divided by sales, efficiency indicator, operating margin, which we had also discussed, operating income over sales, net margin, net income over sales. These are important profitability indicators to know. And others, the previous ones related to the income statement, and others that relate numbers or indicators from the income statement to indicators from the balance sheet. For example, ROA, operational profit over assets, ROA, ROE, or PGU. For every peso that an investor has in assets, how much do I earn in a year in terms of operational profit? Or the ROE, return on equity for every dollar I have invested in equity, how much do I earn? In terms of annual net income, that is the profitability on equity or on net worth. And then, as we mentioned, we have market indicators, where this is essentially valid for companies that are publicly traded. Otherwise, it doesn't make much sense. How to calculate market value is the stock market value, right? The equity is the free value, which is the book value, okay. How does that ratio move? Next, the price to earnings ratio, where we take the market price of the stock and divide it by the earnings per share. As it comes out here, if there is a company whose stock is worth 680 pesos and has earnings per share of 34 pesos, that ratio will be 680 over 34, which is 20 times the earning. So, it is an indicator that investors tend to look at, even though by itself, of course, it doesn't give me much insight into the attractiveness of the company. And then there are some applications, except for this material you have. For example, again for CCU, how to calculate the current ratio, how to calculate the asset ratio, how to calculate activity indicators, how to interpret them, and how to assess the working capital needs that the company may or may not have. Very important, right? Debt ratios, how they are interpreted. Profitability ratios, of course, how they have evolved over time. And the same goes right. Net margin indicators. And here is an interesting way. For example, when one calculates ROA, one can always break down operational profitability into margin and turnover. So, personal profit over assets, which is the ROA, can be separated into personal profit over sales, which is the margin, and that multiplied by sales over assets, which is the asset turnover. And in that way, I can always break down the profitability of any business into its margin and its turnover. I understand that there are businesses that are much more about margins. For example, a high-priced, sophisticated food restaurant, and other businesses that have high turnover and lower margins. For example, the business of distributing pharmaceutical products through pharmacies. Just like the ROE, you can also break it down. You can see that here, some market ratios, how to interpret them. And then the necessity of DuPont, which does nothing but separate this into different values, what we talked about before, which is margin by turnover, and here we are separating these elements, each one in its own merit. So, well, this is what I wanted to discuss with you and ultimately share these very important aspects related to the world of financial analysis in this MBA course at Blackwell Global University.